Hello, personal finance class. So it's been a little while since I've made a video for you guys, but we're getting into chapter 12, which is all about banking. So I guess I'll address the elephant in the room first. Have I trimmed my beard in the last week? No. Am I wearing the same shirt I wore yesterday? Yes. Am I wearing deodorant? No. But what does it matter? Got no one to impress. Haven't left my house in like 9 weeks. So hey, whatever. Anyways, onward. So in this video, we're going to go over chapter 12, parts 1 and 2. So what are our objectives for this video? So by the end of this video, you're going to be able to explain the two major things that banks do, and you're going to be able to describe how banks make money, and finally, you're going to be able to define some basic banking terms. So let's jump right into it. I'd like to cover this entire chapter and hopefully one more by the end of the year, which is a week and a half away. So I'm going to move a little bit quickly in this one. So banks and financial institutions. So banks are what's called depository institutions, and that is actually that is a term that's made up by the federal government. There are only, you have to be accredited in order to be a depository institution, to take deposits from individuals. You can't just open a bank and say, you know what, I'm going to start having people invest in my bank. It doesn't work. You have to be accredited. You have to file for, lots of paperwork. It's very complex, and banks don't let just anyone start a bank. Or not banks, but the government doesn't let just anyone start a bank. So what types of these institutions are there? So there's retail banks, and retail banks serve individuals. So like Citizens Bank, they're open, they have branches, you walk in, you go to a teller. They're most of their service model is based around you and I as individuals. Then there are commercial banks. Lots of banks serve organizations, so big companies. They give loans to companies to build headquarters and to fund new projects and operations, things like that. And then finally, there are things called credit unions. Credit unions serve their own members. Now, the rules have changed around credit unions in the last 10 to 15 years. They've kind of relaxed the requirements on who your members can be. But it used to be that you had to belong to a specific affinity group, or even a church group or a military group, in order to be part of that credit union. So I won't go into too much detail, but just understand that's what credit unions are. That's how they're slightly different from retail banks. They have a specific set of members who are part of the credit union, and those are the people who can get services, not just anybody. So depository institutions, banks, what do they provide? They provide deposit accounts. So in other words, you can walk into a bank and place your money there, and they hold it in safekeeping. So they provide checking accounts, and checking accounts are simply accounts you can open, you can make deposits in them, and you have a checkbook that you can write checks against your balance. This account is for high frequency transactions. So if you get a lot of deposits, or you make a lot of payments, you want a checking account. One of the bad things about them is they offer very low or no interest. So they don't pay you to have a checking account and have a balance in a checking account. It's not what I would call a good investment. We'll get into that in much more detail. They also offer savings accounts. And keep in mind, there are different types of checking accounts, different types of savings accounts, but these are the two general, high-level types of deposit accounts you can get. Savings accounts, so basically a savings account is generally just for deposits, and then you draw it down by either transferring it, say, into a checking account, or withdrawing money from it. It's not intended to be as high frequency. It's low frequency deposits and payments. So you put that to save money. Generally, that's what you use a savings account for. You'll put a chunk of money in there. It could be your rainy day fund, like we've talked about when you're doing your budgeting. You might just keep that money there because you don't plan on using it very often. These do offer interest. The banks pay you to have your money in those accounts, but it's very low interest rates. Any deposit account is going to have a low interest rate no matter what, if it does offer interest whatsoever. But it has low interest rates, but it does offer some interest. And the second major thing that banks do, so one, they take deposits. So people can go there, put money in the bank for safekeeping, and loans. They offer loans to people. So those are the two things. When we talk about that in the chapter, those are the two major things banks do. They take deposits, they offer loans. And so how do banks make money? So the bank makes money. So when I walk into a bank and I say, okay, I'd like to open a checking account and my paychecks go in there every 2 weeks, they take that money and they invest it and they make money off of it. So that's one way banks make money. They take those deposits and invest them in safe investment options that they're going to get a guaranteed rate of return. Again, we'll get into that. Don't worry about it. Another thing they do is they provide loans to people. So we talk about that. Of course, there's an interest rate when any loan that you get, right? We've talked a lot about personal loans at this point. You go into a bank, you get a loan, you have to pay interest on that loan. So they provide loans to individuals, and the interest rate that they have to pay it back at is higher than the rate at which they pay on deposits for their deposit accounts. Like in savings accounts that have low interest rates, banks make money by charging higher interest rates on loans than they give out for their deposit accounts. So one, they invest deposits. Two, they provide loans to people at higher interest rates than they give out. So that spread is what it's called, is where they make their money. And finally, they charge fees. Now, different banks do it different ways, but banks charge fees, all right? There might be a monthly fee to have an account open. A lot of times a checking account will have, like a monthly $3, $5, $10 fee. You can shop around and find ones that are best for you. But that's the third way that banks make money. They charge fees, late fees if you pay your loan back late. But that's their third major stream of income. All right, how to choose a bank. So banks differ very greatly in their fee structures and what types of services they provide. Some banks offer higher interest rates on deposits to attract more people to invest money there, to put money into their bank. Different banks have different fee structures. Like the bank that I use, Citizens Bank, they don't charge me every month to have accounts there. In fact, I've never paid a fee like that because I just wouldn't. It annoys me when I get charged fees, so I don't want to see them. So I use a bank that does not charge me a monthly fee to have an account open with them. Access to ATMs and branches. So some banks are very bad about fees with ATMs. They charge double fees. Like if you go to an ATM and you take out $20 and you pay that $3 fee, you pay that right there and then to whoever owns the ATM, whatever organization or whatever. And also you get charged that $3 again by your bank. So different banks, again, do that different ways. Some people like to earn business by saying, or some banks rather, saying, we don't charge ATM fees. So it's ways to attract people to make more deposits so they can invest it and make loans, and that's the way they make money. So they try to attract a different clientele by structuring their fees and their rates in different ways. And the way you want to bank, so it's best to find one that has a fee structure that's best used, the way they use it. I personally never use ATMs anymore, so I don't care what my bank does with ATM fees. I use them maybe once every couple of months. Doesn't matter to me. Okay, so there are other types of institutions called non-depository institutions. I'll go through this quickly. This isn't really germane or key to the chapter, but non-depository institutions provide financial services, but they do not and cannot accept deposits. So they include insurance companies. Insurance companies, in many ways, work very similarly to banks. They offer a service and they insure you and you pay your premiums. They take that money and they invest it as well. Finance companies, securities firms, finance companies, I won't get into what they are, but these are non-depository. Finance company might be something like a mortgage broker. You go somewhere to get a mortgage. They don't take deposits. They sell mortgages. They originate mortgages. Securities firms, they sell securities. So in other words, they actually sell, stocks, bonds, mutual funds. They do not accept deposits. They don't have deposit accounts. They're not allowed to. They're not structured that way with the government. They don't have the right paperwork and certifications to do so, licenses, all that stuff. These are other types of financial institutions that do not take deposits. Investment companies. Investment companies actually help other organizations, originate their own stock and IPO, initial public offering of their stock. Again, don't worry about this. Other types of financial institutions that don't have deposit accounts, not allowed to. The government doesn't want organizations doing all sorts of different things. They don't want them taking deposits and selling securities and offering insurance. I mean, there are conglomerates that do all of that, but it has to be siloed and under different organization. They can't commingle those services. It's illegal in the United States, anyways. All right, banking basics. So let's get into some of the basic things about banking, things you need to know. So checks. What are checks? So checks are basically a written order from you to your bank saying that you want them to pay money to a specific person or entity. So you write a check out and you say, if say you owe your parents money for something that they did for you. All right. So you write, to mom and dad, $100, and you write the amount. What stinks is we would have a great big project in class, and we would go over exactly how to write checks, and we would have a check register, and it's actually a fun project, but here we are. But that's what a check is. It's a written order from you to your bank saying, pay this person this much money. This person or entity, company. So that check gets presented to your bank in order to be paid. I mean, you can bring a check to any bank. Like, let's say I have Citizens, or I use Citizens Bank. I can write my Citizens Bank check. I can write it out, give it to someone else who banks at, say, Bank of America, and they can take that check and they go to Bank of America and they cash it. Bank of America then has to turn around and take the money out of the account at Citizens Bank, and they have ways of doing that. But that check has to eventually get back to the bank that originated it in order to get paid. So, I mean, one thing you'll notice is that's why there are check clearing times, like personal checks. If someone paid me with a Bank of America check from an account at Bank of America, and I go to Citizens Bank and I deposit, I can't just get cash for that on the spot. They would take it, and it takes 2 or 3 days in order to deposit into my account because they don't know if the money's there. So they're not going to take that risk and give me the money, and then the check has a risk of bouncing. Bouncing meaning the money is not there in the account and it does not get cashed, and you don't get your money. That's why a lot of places don't accept personal checks either. So basic checking account cash flow. So, of course, money comes in, that's inflows, and money goes out, outflows. So what kinds of ways does money get into your account? So simply put, these are usually just paychecks or other types of income. Maybe you guys still have, maybe your parents give you an allowance every week. You take that and you can put it into the bank, whatever, $20 a week, whatever you happen to get. So that's your inflows. That money goes into an account, and then of course you have your outflows. So first thing is going to be your fees. So any sort of ATM fees, bank fees, overdraft fees, return check, stop check. Don't worry about those right now. But that's money that comes out. So you have to be aware of all that money that's going to come out each month because you need to balance your checkbook. Of course, your checks. Any checks that you write come out of your account. Any ATM withdrawals that you take out. So that's cash you get from the ATM machine, the automatic teller. Obviously that's an outflow from your account. And then most accounts these days come with a debit card. So it's kind of like a credit card. It works just like it. I mean, a lot of them, you'll see that this one has, of course, has fake zeros on it for the account number, but it has a Visa on the side. So anywhere Visa is accepted, they will use that just like they would a credit card, but instead of having a credit balance at a credit card organization, it comes directly from your balance at the bank. And you can spend it, again, anywhere that accepts that type of credit card. So you can, go on Amazon or go to the grocery store, anywhere you want that accepts that type of credit card. And you can use that, and it comes directly out of your account. All right, so checks. What do checks allow you to do? So checks are good because you can safely send them in the mail. You don't want to send cash because there's no record. I mean, if someone could intercept that letter that has however much cash in it, take it, and boom, it's gone. You'll never know who took it, and it's gone. There's no safety there. But checks, it has to get cashed. Someone has to sign it, bring it to a bank, and cash it. So there's always going to be that paper trail of who cashed that check. And if it doesn't get where it's supposed to, if you send it, you can always cancel payment on the check too. So it allows you much higher security than cash. It also allows you to maintain records. You can see a record at the bank in your check register that, first of all, you wrote the check got cashed. Someone can't say, hey, you didn't pay me for whatever. You can say, yes, I did. And this person cashed it. So not my problem. It's very common, and you should never pay someone cash without getting a receipt. Contractors do this a lot. They'll come to your house and say, all right, okay, well, here's the work I'm going to do for you. I require, 50% payment up front. And if you pay them cash, they conveniently forget that you paid them. And if there's no record of you paying them cash, then either you have a dispute and there's no evidence and you're screwed. Or I don't know what the other option is. You keep working with them. I mean, doubt that. They just walk away with your cash. So always get a receipt. And even better, don't pay with cash if you don't have to. And if you do pay with cash, get a receipt. All right, a Now account. To be honest, I didn't even know what these things were before I started teaching this class. A Now account is a negotiable order of withdrawal. It's virtually the same as a checking account. The one major difference is it does offer a little bit of interest each month. It pays a very small amount. So when I say a small amount, right now rates are around 3-ish%, maybe lower, 2.5% to 3%. You're going to get something like 1/8%, maybe 0.5% if you're extremely lucky. So virtually nothing, but it does offer a small pittance of interest. However, they do require a minimum balance. It's usually something like, $1,000, something like that. All right, debit cards. We talked about them a little bit, so I won't beat that to death. But they usually are provided by banks to their account holders. They're very convenient. I mean, banks prefer that you use a debit card over checks because checks require actual paper processing. So that's why checks are they're not as popular as they used to be. That's for sure. When it's all electronic, it's a lot cheaper for the banks to process those payments. So they prefer to use debit cards instead of checks. And again, they look and act just like a credit card, only you can use them at the ATM machine and the money comes right out of your account. There is a 4-digit PIN number for purchases and withdrawals. So if someone gets your card, at least you have that additional layer of security. They can't use it unless they know your 4-digit PIN. So using your checking account. Here's where we talk about balancing your checking account. So you have a set amount of money that's going into your account each month. You have to understand how much is coming out, and you need to reconcile just to make sure that there's not like fraudulent charges, and also know that you're not going to bounce a check and you're going to have enough money in your account. So you need to keep track of all the checks that you write in your check register. So again, it's not the ideal way to teach this material virtually. So you need to write down everything you do, make sure that you're going to have enough money to cover it, because it doesn't happen immediately. And if you give a check to a person, you have no idea what they're going to do with it. They may wait for a month before they cash it. And you need to know that that money is still out there, because you can't just look at your balance and say, oh, hey, I've got, $500 left in my account. If you have a $400, check that you had sent, a week ago and they haven't cashed it yet, you got to know that that's still out there. You don't want to bounce your next check. And you need to reconcile your bank statements regularly. I do still do this. I go in and I make sure that I recognize everything that is in my account. And I have found things and I've had to call. And you know what? I think I've done it 3 or 4 times, and all but one time, it was fine. And it was just something I'd forgotten that I'd done. But that one time, a company charged me twice for something. So I called them and they reversed it. Pretty simple, but I don't think it was intentional, but you never know. Okay, so that sums up Chapter 12, Parts 1 and 2. So let's review. So, what are those two major things that banks do? How do banks make money? What are the ways that they make money? What are some of the basic banking terms that we talked about? Just list me two of them and explain what they are. And that's it. I went through this a little bit quickly because we're here at the end of the year and I want to get through some of this material. But go ahead and answer these questions and let me know if you have any questions of your own. And I'll see you in a video in a few. Thanks, guys. Bye.